The most dangerous investment fraud in history did not promise to make people rich overnight. It promised something even more seductive, that they would never have to worry. Bernie Madoff looked like the safest man on Wall Street. He had built a legitimate securities business, served as a chairman of the Nasdaq stock market, and moved among some of the most respected names in finance. To investors, he did not look like a reckless gambler. He looked established, connected, and boringly reliable. That image became the perfect disguise. Madoff's investment advisory business reported remarkably smooth returns, even when markets were falling. The gains were not so spectacular that they looked obviously absurd. They were simply consistent, month after month, year after year, with very few reported losses. Clients received detailed statements showing stocks and options that appeared to have been bought and sold at just the right moments. But those trades were largely fictional. Madoff claimed to use a sophisticated strategy involving major stocks and options. In reality, money from new investors was deposited into a bank account and used to pay clients who wanted to withdraw funds. The account statements were not evidence of successful investing. They were props, created to make imaginary profits feel real. So why did so many intelligent people believe him? Because Madoff did not sell only returns. He sold access. Investing with him felt exclusive. New clients often came through friends, relatives, country clubs, professional networks, and charitable organizations. People saw respected members of their own communities already invested and assumed someone else must have checked everything. The harder the fund seemed to enter, the more valuable it appeared. That is the power of social proof. When everyone around you seems convinced, asking basic questions can feel almost embarrassing. Madoff turned reputation into a substitute for verification, and the red flags were hiding in plain sight. His results were unusually consistent. His strategy was difficult to verify. Investors relied heavily on records produced by his own firm. Independent analysts questioned whether the reported trading could even have happened at the scale he claimed. Warnings reached regulators years before the collapse, but the scheme continued. Then came the financial crisis of 2008. As fear spread through global markets, clients asked for their money back. In early December, redemption requests reached roughly $7 billion. Madoff could not produce it because the wealth shown on his clients' statements did not actually exist. On December 10th, he confessed to his sons that the investment business was a fraud. They contacted authorities. The next day, Madoff was arrested. The numbers that followed were almost impossible to understand. Customer statements had shown around $65 billion, much of it invented profit. Thousands of investors, charities, and institutions were affected. Some victims lost retirement savings. Others discovered that the fortunes they had planned to leave their families had never been real. In 2009, Madoff pleaded guilty to 11 federal crimes and received a sentence of 150 years. But the most disturbing part of the story is not that one man lied for decades. It is that his lie was designed to look like safety. He understood that people are suspicious of promises to get rich quickly, so he offered the opposite: calm, steady, almost boring success. He made doubt feel unnecessary and exclusivity feel like proof. The lesson is not to distrust every successful investor. It is to never let reputation replace independent evidence. Ask who actually holds the assets. Demand statements from an independent custodian. Verify the auditor. Understand how returns are produced. And be especially careful when an investment seems unusually smooth, secretive, or available only to the right people. The safest-looking opportunity can sometimes hide the greatest danger. Would you have questioned Bernie Madoff, or would his reputation have been enough?